Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Friday, March 10th, 2023. Good unemployment numbers today, or I should say, good employment numbers today, coming in at 313,000. That is above the non-farm payroll number that was expected, and particularly roughly in line with what we saw the previous month. Remember, 500,000 new jobs in January surprised the market. It really started this cascade towards expecting even higher interest rates. At the same time, wage growth was, pretty stable, but at an elevated level. So this continues the narrative. We see it in the details too. We see healthcare, we see education, and we see leisure being the primary driver of these gains. So the employment environment remains solid. And so that is something the Fed will have to deal with as they meet at the end of the month. Getting down to the details, we look also at the household survey that came in at 177. That was a considerable step down to the 800 we saw in the previous month. But in there, we actually saw that people are coming back into the labor force. That's a constructive sign. That's why you saw the unemployment number moving up to 3.6 to 3.8. Realize this is somewhat inside baseball, but it's important to note the two different surveys. The establishment survey is running a little bit ahead of the household survey. The probably different characteristics. So it probably tells you that somewhere in between the two surveys, we still have roughly 300,000 average growth over the last 12 months of jobs. So there's really no level. The chair, Powell, has commented that weakness or even a slowdown would be under 100,000. So we have a far clip to see from that. Now, it is healthy that wages are moving south a little bit with the new entrants into the labor force. So we're seeing the yield on the bonds stepping down from those. So net, positive labor market, positive element. Now, what the Fed really does have to consider and what's easing into the market is beyond the labor number is Silcon Valley Bank. And so we see a run on the bank occurring there. They were a bank noted for what we call hot deposits. They were not retail based. They were more internet or based online. So they were attracting with a higher interest rate funding the deposit side of the equation for their operations. And so as people withdraw those CDs, and remember, you can withdraw a CD, you just lose 6 months of interest on the CD, and therefore you can move it out pretty quickly. The loans, the banks are not that liquid, so they have troubles raising funds to meet that drive. Liabilities of the bank, the deposits leave, they're stuck with the loans, then therefore they start having a mismatch in their capital or reserves, as we would consider it, and they will need some help, maybe some type of restructuring as we move forward. But what's more important is, yes, the financial institutions are vulnerable to these negative inversions. And when they get even more sizable, then it's harder for banks to manage that, because generally banks want to loan long and earn short, and therefore pay out short. So the flows out to the deposit base is a little bit shorter than their loan base. So that creates a natural tension and the need, therefore, to have some capital and regulatory supervision. Will this cascade? Well, probably not a significant, but it is a warning sign to the Fed that there's only so much give to the rubber band. And so when the rubber band expands too much, meaning the difference between short rates and long rates in an inversion, something's going to give. And this happened back in the 90s, and not surprising to see it happen today. something to keep our eyes on, but I do think along with some positive numbers on the inflationary, it'll keep the rate increase to a quarter. And as we move forward, it will sort of lower the enthusiasm in the central bank to raise interest rates. This is Scott Murray with the Daily Economic Market Chat. Thank you for joining me.